Why do you think the technical setup so favors, a slide? I've been hearing a lot of that, frankly, over the last many weeks, and this market has just proven more resilient than I think some of the fundamental analysts expected, and certainly the technicians too.
Yeah, thanks for having me back again. And in fact, the last time I was on your show was about a month ago, and I'm pretty sure the S&P was trading just about in the same spot it's trading right now. So I would say, as a bear and someone who's been bearish since the start of the year, we first got negative when the S&P got up near 4,100 in December, in the middle of December, and have been that way since. It's been a bit frustrating, but if anything, as time has passed, while the headline indices have stayed roughly, where they are here, we've gotten incrementally more conviction in the view through the internal rotation. So number one, the market leadership's gotten more and more clustered into just a one spot. There's a handful of stocks that lead the market. You can see just by looking at something like the S&P 100 against the S&P 600, so large cap over small cap. That tells the story right there. It's been mega cap leadership that's keeping the market bid where it is. Underneath the surface, you've seen cyclicals rotate to defensives. Again, large cap to small cap. That's all consistent with a late cycle environment. We've seen bull steepening in the Treasury curve really start to take hold, not just in equities, but in other global markets like industrial metals under pressure. All these things are consistent with late cycle environment. The equity market has held up, and it's been more of a flight to quality than flight to cash up until this point, and that's hung on a bit longer than we thought it would. But we still think that's to come, that you will see the eventual more full pricing for recession probability.
I know, but they're not like these are lousy stocks. I mean, it's hard to chip away at these things. There's a reason why the money's gone there in the kind of environment we're in. I mean, I could see if maybe we're talking about another sector, or I mean, they got the best balance sheets. They got piles of cash.
That's right, and really, like I said, this is typical late cycle behavior, where as growth starts to decelerate but not move into negative territory, the money moves into the more quality names, and you get more and more concentration as you go. That's why, from a technical point of view, you see the breadth really start to thin out, and the leadership really start to dwindle to a handful of stocks as you get later and later in the cycle. But at some point, and as the growth data starts to decelerate more toward negative growth territory, that's when you tend to see flight to quality turn to flight to cash. And you see that rotation where we actually think these mega cap names may temporarily, a brief period, they may be more at risk than the more cyclical companies because of the crowding that's developed here.
I wonder, though, as some might counter and say, maybe we are at the beginning of a new cycle, fueled in part by AI. Well, all of these advancements that we're talking about, and maybe we're looking at this wrong.
Yeah, so I mean, if one's going to make that argument, what you typically look for are what's typically the tip of the spear, the leading cyclicals. Things like a copper-gold ratio, the semiconductor space overall, not just the ones particularly in the AI space. Financials versus utilities. What you have here is actually over the last several weeks, cyclicals coming under more pressure versus defensives, not the other way around. So unless you're telling me it's AI specifically that's going to drive this, and just this small handful of names is going to carry the market into a new cycle and make up that entire leadership the whole time, could it be different this time? Sure, it's happened in the past where it's been different. But what's consistent with other late cycle environments to what we see right now, it's a fairly typical story. You see the thin leadership, and then at some point the growth decelerates enough to cause a true flight to cash. And the crowded names, like I said, for a brief period, you can see the quality come under more pressure than even the small cap or cyclical sectors. I'm
just wondering, if it may help you tread water, so to speak, for a while, stay in this tight range amid uncertainty about the economy, which is the reason why cyclical stocks haven't done well, until we can further answer the question of whether we're going to have a soft landing or not. And if these large stocks can help keep you afloat until we can answer that question, maybe you get through the rough waters and you actually have the ability to get the market to the other side.
Yeah, and then that's where we've used a number of models to help make our case over the last few months. One of them is, let's say if it is the soft landing scenario, where the Fed doesn't have to ease through neutral rate. Well, one of the models we have looks at Fed expectations and economic surprise data, things like that. And it's a regression-based model, and it predicts where the S&P should be based on Fed expectations of how high is the interest rate expected to get in the tightening cycle, and then how low is the policy rate expected to go in the subsequent easing cycle. Right now, the fixed income market is effectively priced for a soft landing, and many people, I think, rightly make the case that it's not really looking for a soft landing. It's basically a binary bet. Is the Fed not going to do anything at all, or is the Fed going to have to do a lot of easing as we move into the latter months of this year and into next year? But as it's priced right now, it's effectively pricing for a policy rate to move back to neutral, which one would say is consistent with a soft landing. Even if that's the case on our model, the upper end of where the S&P should trade here is 4,200, maybe 4,250, based on how it's traded over the last 2 years. So even in that scenario, the S&P is at 4,200, is in a way fully priced.